Welcome back, friends. Thanks for joining me for another episode. Super stoked that you're here. So today we are going to talk about the only two pieces of guidance that the IRS has actually issued related to virtual tax or virtual currency. All right, and it's important, you guys, to just picture that the tax law itself is thousands and thousands of pages. All right, the guidance we have for virtual currency is 17 between the two documents. All right, so there's not a lot out there. But I want to today talk about what is out there and just in top level, very high view, talk about what is out there and kind of put together the pieces of why that's important to you guys. All right. So the first document that was the guidance that was released was Notice 2014-21, released back in 2014. So keep in mind, this was the very first piece of guidance that we received, and it's the only piece of guidance we had until October of 2019. All right, so just think about that. The only piece of guidance we had for 5 years or more. So Notice 2014-21 defined what they call convertible virtual currency. And what they said is that that is any type of currency with a US dollar value attached. All right, so Bitcoin, Ethereum, Litecoin, Dash, all of them are considered convertible virtual currencies. So this notice was issued as a Q&A with 16 questions and answers. We are not going to go over all of them because some of them are boring, some of them don't pertain to you guys really, and some of them are very repetitive. So we're going to just go over the highlights, right? We're going to do a highlight reel today. All right, so first, this guidance says that crypto payments received for goods or services must be used when calculating your gross income. It's treated just as if you received cash for the said goods or services. What that means is if you have a business, or even if you don't, if you provide a good or service to someone and they pay you in crypto, that is income to you. Just like it would be treated as income if they paid you cash, okay, or a check or by credit card, okay? Receiving money in exchange for a good or service is ordinary income to the person receiving it. And this guidance says that is so even if it's crypto you're being paid in, okay? We will talk about this in depth in episode 3. We'll go into all the details about this, but for now, boom, boom, that's what you need to know. So the Q&A goes on to define mining as a business. Last week we talked about mining, data mining. So those are the people that are not breaking down the blockchain, but digging into the blockchain and digging into the information, into the data. That's what I wanted. So crypto that is received by a taxpayer who mines is considered ordinary income and is subject to self-employment tax as well. So basically what they're saying is if you're mining data, you're in business, just as if you were giving real estate, being a real estate broker or an accountant, okay? You are in business. That is self-employment tax, or self-employment income. So you are subject to self-employment tax. We will have an entire series just for the crypto miners out there in a couple months, because I know we have a handful of you guys. So it's important for us to break it down and figure out what all those taxable events are for you guys. All right. So then the meat and potatoes of this crypto guidance, that's Notice 2014-21, goes into detail about how crypto is treated from an investment aspect, okay? So they say that crypto is considered property, and so what that means is it's treated very similar to stock or brokerage investments. So we will go in depth into this in episodes 4 and 5, but here are just a few of those main concepts. So again, think about this just like you do a brokerage firm, so when you purchase crypto, the fair market value on that day that you buy it is your taxable cost basis. Okay, that's just the same as if you go out and buy Facebook on the stock exchange. Okay, your cost basis is what you pay for it the day you buy it. Okay, that applies to crypto as well. When you sell crypto, and please note that this includes if you exchange one type of crypto for another, they consider that selling, then your proceeds are based on the fair market value on the day it's sold. So if today is the day I actually sold my Facebook stock, what I get for it is the value that it is at today. So same thing with crypto, okay? So when you purchase, that's your cost basis, the day you purchase it, the value it's at. Your proceeds are the fair market value on the day it's sold, what you receive when you sell it. All right, so then we move on to Revenue Ruling 2019-24, and that was released just back in October. And this guidance is all to do with airdrops and forks. So these are definitely more advanced topics, and they have their own episodes planned out again in a few months. But for now, I do want to talk about it because it will affect your 2019 tax return if you engaged in an airdrop and a hard fork. So you guys, I'm going to make this as easy as possible. So a hard fork is when a crypto splits, okay? So let's say Bitcoin, part of it splits and they make Bitcoin too, okay? So the Bitcoin you own splits, okay? It's called a hard fork. And the first question in this guidance says, does a taxpayer have gross income as a result of a hard fork of a currency that the taxpayer owns if the taxpayer does not receive units of the new cryptocurrency? So they're saying it hard forks, it splits, but you don't get any of the new currency. The answer is no. There's no taxable event. There's no gross income, okay? You still just have the old Bitcoin 1, we'll call it. Okay, the second question asks, does a taxpayer have gross income as a result of an airdrop of a new cryptocurrency following a hard fork if the taxpayer receives units of the new cryptocurrency? So in this illustration, it splits and you get some of the new crypto. Airdrop is just the delivery method, okay? And the answer to that is yes, because and it makes sense based on everything else we've talked about today, because you're receiving this new crypto income or cryptocurrency, okay? So the hard fork itself does not result in gross income, but an airdrop of new cryptocurrency following a hard fork does. Again, if this went over your head, if it doesn't apply to you in 2019, it doesn't matter. We will talk all about it in future episodes, and if it does apply to you, then we'll talk about it in depth then, so you can start figuring out how it applies to you, all right? So that's it. Those are the two pieces of guidance that we have related to virtual/cryptocurrency as of 2019, December 2019. We can expect to see a lot more in future years, in upcoming years, but this is all we have right now. So this is the basis for everything we're going to talk about in future episodes. Cool? Cool. All right, thanks for joining me. If you haven't already, please subscribe. That way you get notified when we drop a new episode. And definitely let me know what you like, don't like, questions you have, what you want to see, so that we ensure that we are answering the questions you guys have, because this channel is made for you. All right, thanks guys. Have a good one.